Now that is a very good question, and there are some key areas that we do need to watch for when it comes to looking at tax returns to establish income. In this case, we use tax returns because HUD tells us that it is the net income from a business that we count as income to a household. So the business has gross income, and then it pays its expenses, and then the net income from the business is what the household actually realizes as income for purposes of affordable housing. For this reason, the Schedule C becomes important because that tells us the gross income, all the deductions, and the net income. And it's those deductions that show up on the Schedule C for the most part that need to be watched closely. Now, we suggest that there are 5 key items on the Schedule C that need to be watched. If we miss them, it could get us into trouble. Now, we're going to use specific form numbers for this discussion, and those are the numbers from 2011. They may change in future years, but the concepts that we'll talk about will still stick. So not only the form number, but the description of that item is what will be important for this discussion. Now, the first item that you'll want to check as you examine the Schedule C is line item H. This is checked if the owner started or acquired the business during the tax year that the form covers. If this box is checked, you'll want to get a written clarification from the business owner as to when the business began. Here's why. For example, if the net income on the prior year's tax return was $4,000 and the business started halfway through the tax year, $8,000 would be used as the starting point to project income for the upcoming certification year, because $4,000 was only half the year. To use $4,000 would understate the income since that was only half a year's income. The second and third items on the form that you'll want to examine are line items 11 and 26, which are expense deductions when they paid contract labor or wages out of the business income. If there is an amount in either of these fields, you'll want to obtain written clarification from the business owner as to whether the contract labor and or wages are paid to anyone in the household. If it is, the amount is counted as household income in addition to the net income from the business. For example, Lisa is self-employed. Her full net income from last year's tax return was $10,000. That was a full year's worth of income. The tax return also indicated that $5,000 was paid out in wages before the net income was calculated. The manager clarifies with Lisa that the $5,000 in wages was paid to her spouse, who is also part of the household. So the manager would rightly count the $10,000 as net income from the business and would also count the $5,000 in wages paid to her spouse, since the money was not counted in the net income from the business. The total income of $15,000 would rightly be counted. Fourth, you will need to watch what is listed on line item 13, or depreciation. HUD tells us that net income is the gross income less business expenses, interest on loans, and depreciation if it's computed on a straight line basis. HUD further clarifies in Appendix 3 of their handbook that the business owner would need to provide an accountant calculation of straight line depreciation expense if the accelerated depreciation method was used on their tax return. This means that if depreciation is listed on the Schedule C when you're examining the net income from a business, clarification must be obtained to demonstrate what method of depreciation was used. If the straight line depreciation method was not used, the applicant-tenant must provide an accountant's statement or calculation of depreciation using the straight line method, and that should be used instead. The accelerated depreciation used on the return will need to be added back into the net income, and the straight line amount then subtracted for a HUD-appropriate calculation of net income from that business. The fifth and final concern is that you need to be aware of the rules if line 31, or the net income profit or loss from the business, is negative. If it is negative, it must be counted as zero income. The loss cannot be used to offset other household income. These are the items on the Schedule C that we have seen in our auditing of files all across the country that tend to cause problems for affordable housing managers. Any one of them could affect the math and could result in income being anticipated too low for that business. So now we've gathered the tax return. We've looked it over and diffused any areas that could get us into trouble on that Schedule C, and we've done our calculations. It's important to realize at this point that this is only the starting point. We also need to get current financial statements from the business as to what's happened since last year ended, as well as what they anticipate to happen in the future. This needs to be compared with those tax returns. And any discrepancy needs to be explained, especially if they anticipate having less income than the year before. Then the business owner will have to provide some sort of documentation to explain and to establish that yes, indeed, the anticipated income from that business is less than it was in the prior year. At the end of the day, the business net income or loss should only be used from the tax returns when the business is anticipated to do the same this year as it did last year. And only then should those numbers be directly applied to the certification.